And a big welcome to our live audience for Digital Health Investor Talk. I'm your host, Steve Wardell. I'm the managing partner of Wardell Advisors, a digital health advisory firm and the author of The Future of Digital Health. Wardell Advisors is helping digital health companies address issues around growth, fundraising, trade sales, and strategic alternatives, giving you more options in today's challenging environment. You can follow me at x.com/Stephen Wardell. Our show today is on the topic, what adds sizzle to a fundraise or acquisition? Our guest today is AJ Loyacono. Is that how you pronounce it?
It works.
AJ is the CEO of Capital RX, which provides enterprises with a platform to manage their pharmacy benefits. Follow him at linkedin.com/in/Capital RX. This show is being recorded and will be included in my podcast series called Digital Health Investor Talk. Subscribe to our podcast on Apple and Spotify and leave us a review. We always love getting a 5-star review and would appreciate one from you. We have new podcast links for our shows, so make sure that you see recent episodes when you subscribe on Apple and Spotify, or else you might be subscribing to the old podcast page. This is not investment advice, and we are not investment advisors. Here's the format of today's show. It'll last about 90 minutes, and AJ and I will spend the first half discussing the news and the macro picture and some other topics, and then we'll focus on our special topic of the day. So AJ, welcome to the show, and please introduce yourself to our audience.
Thanks, Steve. I'm AJ Loyacono, the CEO of Capital RX. I hear a little bit of an echo. I'm not sure it's me or you, but we'll get through it. My background is I've been in the...
I'm not hearing that on my side, so that's good news.
No, good. Been in the pharmaceutical supply chain for 24 years, all of my career in software development. I presently am the CEO of Capital RX, and we're a PBM, Pharmacy Benefit Manager, serving self-insured entities, and we are also a PBA, Pharmacy Benefit Administrator, where we license our technology and services to large health plans and health systems.
Great, thank you. So now we'll move on to our first topic of the day, which is macro news. And I like to look at macro news from the perspective of the innovation economy, which is young companies who are innovating and the investors who back them. And we're in a kind of a tough time for the innovation economy. There's economic uncertainty, there's higher interest rates, there's a freeze in the investor environment. And so we're looking for what the macro news of the last couple of weeks means for this particular group. So I guess if I were to summarize it, I'd say there's still moderate concern about inflation and a hope that we've either seen the last of bad inflation and that therefore the Fed can feel confident in cutting rates. And I think people would really like to see rates cut, but not if inflation is still out of control. It has to come after inflation is more under control. And we have mixed news on this front. We have inflation that's worse than we'd like, but it's not galloping inflation out of control. People also think that the official numbers don't reflect actual societal inflation. So we're in a mixed situation. And Jerome Powell seemed aggressive about cutting rates 3 months ago and seems to have become more conservative, less likely to cut rates over the last 3 months. And he said that we have to worry that interest rates may need to be higher for longer. In that context, I think investors initially wanted 3 rate cuts at 25 basis points each by December. Now they're talking about 1 rate cut by December, but at least we're not talking about unexpected rate rises happening, which is what happened 2 years ago, which set off this whole frozen environment. And the next Fed meeting is July 30th, 31st. So AJ, any thoughts on the macro environment? Any tea leaf reading about what the Fed's going to do, what inflation, jobs, and rates are going to do?
Well, I think everybody is just kind of in a wait and see pattern for the latest economic indicator that might make people more bullish or bearish based upon the data. I think consumption is the next index that comes up on Friday. So we'll see what happens there. But in general, I think gauging inflation is very difficult. I always want to preface this. I'm no economist. I'm an amateur by training. One of the things that I always remembered, and people can correct me on this, is when I think of the consumer price index as it backs out certain things that might be viewed as very important to the average American, such as gasoline and food. And so, I think sometimes when we use indicators and we say, oh, it looks pretty good, but, why is this not being sold to the average American? It's like, well, what do I care about more in a household is, I have to commute, travel may become more expensive, food, feeding children, family, friends, etc. These are things that are, perhaps concerning in winter months, heating through fuel, things like that. And so I always found it strange. Like there's this professor or academic view of inflation, and then there's a real world inflation. And I always said is someone should have like a real world inflation index of things that actually matter to people.
It's a good point, and some people are so frustrated with the official inflation statistics like the Consumer Price Index (CPI) that they actually are tracking their own measures of gas station signs and grocery store numbers and that sort of thing, and they come up with numbers significantly higher, like 30% inflation since the start of this inflation wave or that sort of thing. So it is something to, and here we're talking about the difference between, was it 3.6% inflation versus 3.5% inflation? But people are definitely often feel it, harder in their wallet than those kinds of numbers would suggest. So.
What's funny is also, if I remember my news cycles correctly, I spend every morning trying to ingest as much information as possible. And then, the question is, how much do I retain? But I'm pretty sure I read that, median home, sale prices reached the highest level in the United States. I don't know if it was last week or maybe it was earlier this week. I don't remember. But again, just another indication of real world economics. Hey, I'm a first time home buyer and everything's expensive, or the highest level anyone has ever seen before. And so, I think, there's two worlds. There's the economist view, which is, hey, what are some of the indicators telling me? And then there's this real world view of, I may not agree with some of those indicators, and it's interesting. I always say what would be a funny mashup of data to kind of be like a weird indicator of inflation was, I always say, if you're familiar with Steam as like a streaming game service, is the number of sales that are ongoing at the same time. Because if someone's not buying a video game, it means like they're tightening, they're spending. And the more sales are a response to people not buying at the velocity that they're used to on Steam, I always feel like. So I always wanted to do that. I'm sure there's a way to, get to that data, because I see people obviously posting, different trends through Steam. But I always thought that would be an interesting macroeconomic indicator of consumer sentiment.
That sounds like a great leading indicator, because you got young men being a little tighter on buying the video games on a Friday night or whatever.
I'm sure Steam will tell you it's 40% women as well in their demo.
That's a leading indicator.
Yeah.
And I won't dwell on this too much, but one of my favorite stories is that MBA career choices are the best lagging indicator. So if MBAs are all going into real estate, that means real estate's headed for a terrible crash. If MBAs are all going into venture, it means venture's headed for a terrible crash. So anyway, so that the next on the horizon here, we've got the next Fed meeting is at the end of July. So good news there. You can enjoy your summer, for the next 6 weeks without thinking too much about the Fed. But we'll expect the Fed to be wrestling with this question of, have we tackled inflation? If we have, then we can lower rates. If we haven't, then rates have to stay higher longer. And the Fed will hint about whether we might see one rate cut by the end of the year, or 0 or 3, which is what the market would like. And lastly, I'll dwell on the NASDAQ at 17,800 right now. I think nobody saw this coming. The NASDAQ a year and a half ago was at 10,000. So if you wanted to be a genius, if you wanted your friends to call you a legendary stock market genius, all you had to do a year and a half ago was put your money in the NASDAQ, which, by the way, people didn't necessarily see the NASDAQ as being about to go up further. Among other things, it includes a lot of big tech in it, and they had already risen a lot during the pandemic. And so some people thought that we might see a rest in, they were going to let earnings catch up with valuations. Instead, we've seen the NASDAQ roar, driven by the same FANG companies also there. And so I think this is good news in general for digital health innovation economy, because it's good news in general. It'd be better if digital health stocks were up as well. In general, digital health stocks are not performing nearly as well as the NASDAQ, but the market's up in general, driven by big tech. And this has a contagion effect. It causes VCs to say, if things are looking good, why are we holding back so much? So to give you an idea, in terms of Series CD, crossover, and IPO, it's down like 80% as compared to 2 years ago. Rounds A and B down 60, 70%, and then seed down 30% or something like that. And that's because VCs have money but are not investing it. They're being cautious. They're working on internally. They're fleeing to safety. They're not investing. They're triaging internally. When they see indicators like the NASDAQ at record highs, it makes them say, well, we ought to be able to put money to work and then eventually take it public and collect those later. So anyway, any other thoughts on macro news that you've seen recently or that's coming up?
No, I think it's wait and see. I mean, I see the data that everybody else is looking at, day in and day out. Like, strategic petroleum reserves are up 3 million gallons. Who cares? I always look at things like that, not really moving in one direction or the other materially. Seems in line year over year with levels they were before. So I think a lot of it just comes down to wait and see. And to your point, let's enjoy a restful July and see what happens with the next meeting, the Fed.
All right, so then moving on to the next topic, industry reports. Do you follow any reports? Have any reports come out with important findings lately for you? So I have not seen any in the last couple of weeks that were worth bringing to the audience. But any reports have come out that you think is worth talking to the audience about?
No, nothing of note or interest in particular that I was, attracted to or, saved. I think it's been, I don't want to say just a lackluster reporting period. Nothing worthy of print.
Okay, so moving on to the next topic, which is trade journal news, business news. I guess and I like to look at fundraises in this for this topic, and I have to say this is really a time of there's more wind downs and more exits in digital health than there are fundraises still for 2 years. And a question I have is, are we turning the corner? Are we starting to see some warmth in the fundraising market? But why don't I just start off with, what's the biggest story in healthcare right now? Do you have a candidate for the biggest story?
Well, I'm a little biased. So I think if you look at the article in the New York Times the other day, giving some pretty negative coverage of the pharmacy benefit industry, followed by the Wall Street Journal sharing a similar report, but taking it from the lens of mail order performance, again, kind of serving up a black eye to the legacy spread pricing PBM industry. I think that is one of the bigger, moments in healthcare that I'm looking at right now, when you have, two very prestigious papers, reporting on the same topic from the same angle.
And thanks. That's interesting. And you work in this area roughly. How can it be that someone who has coverage from a plan and a PBM, they get an expensive drug and their plan is charged $125,000 for the drug, and then they can look in a different place and find the same drug for $40,000 or whatever? How does that work? And
Yeah.
and how does it matter to the individual? and can they empower themselves to take advantage of a differential through half an hour of work?
Well, I mean, it definitely matters to the individual. So, for every Cadillac plan that might have a $20 copay for a branded product, there are people that have high deductible plans, or they have obviously coinsurance, or even just higher flat out of pocket, you know, $250 specialty drug, copay. But I mean, from real world data, I've spent a long time looking at this. The average patient, the average patient starts to reject a claim around $75 of copayment. And so think about this. So you have statistically about a 1 in 5 dropout rate once a patient is presented with a copay of $75 and up. And then when you go to $120, that dropout rate increases even further to 1 in 3 patients. And, what is someone doing at $120 copay? They're saying, okay, this is my cell phone bill. This is my grocery bill. This is car payment, insurance payment, real life expenses you're balancing, unfortunately, against your health. You're willing to sacrifice sometimes because, in your hierarchy in your head of needs, you're saying, I need to have a roof over my head and eat before I can concerned about my health, unfortunately. And that's a scary situation. Back to your statement, does this impact patients? Absolutely. I mean, the vast majority of plans at this point in time are not what we call these Cadillac plans. These, everything's covered, don't worry about it. You're having real world cost as a patient. I think the other part is, how does this happen? Well, I think this is the black eye of the PBM industry. And this is, often, the dark arts of reclassification, where someone goes, there's a generic available. And so they could either A, in the generic GPI category for that therapeutic treatment, is they could choose the most expensive NDC 11, which is the National Drug Code, and in the 11-digit sequence to identify the manufacturer, the package size, the type of form, is it tablet versus capsule, etc., and the milligram, the strength of it, etc. But someone's picking the most expensive one, which is the innovator drug, which is effectively trading at the brand price. So someone can either A, just pick the most expensive thing, which is sad, or two, they can reclassify the drug as a brand and then move it from an aggressive discount of 90% to like a branded mail discount of 24, 26. Your mileage will vary. This is off of AWP. The other thing that they could do is even repack the damn product, which is take the product, same exact actual drug, issue a new NDC 11 that just happens to be 50 to 60%, 100% more expensive than the original drug, and then pass that on to the patient. All of these decisions, unfortunately, Steve, are designed to make more money for the PBM. And, I've said this all along, is the biggest issue is that the industry moved away from its roots, which is to just be an administrator and charge a flat fee, to making money on drugs. And the moment an administrator, because let's be frank, that's what a PBM, a pharmacy benefit manager, is doing. You're managing drug spend. Is the moment you get to that point of making money on drug spend, inherent conflict of interest is the more expensive the drug, the more money you make. Now, if someone just made a flat administrative fee, these decisions that I described, scenario A, B, and C, are all pretty shady. But at least you could say, well, they weren't making money on it. Maybe there was a reason. But if you're making money on it and you pick any of these prior examples, again, impacting the plan and the patient in the process, it's bad form. And I think that's why you're seeing the New York Times pick up on it. I think that's why the Wall Street Journal is picking up on it. And I don't think it's going to go away. I think people are tired of drug inflation at runaway numbers. Drug inflation obviously makes CPI look like, a gentle deflationary dream.
Really interesting. I think that that's a great candidate for the biggest story right now, especially because of the big New York Times, feature-length story on this phenomenon. I'll throw out there for our audience my candidate for the biggest story in healthcare right now is actually the Ozempic and Wegovy and that continuing story, which continues to get bigger. So what I throw out there is that when I last checked in on this story, it was about a couple of things. It was about how there was there was a run on supply, a lack of supply of
Sure.
these drugs. It was also how these drugs are expensive and they are approved for treating diabetes, but they're not necessarily approved for wellness weight loss of people who are not otherwise sick. And so dealing with that issue. And then also it was an intriguing issue of some employers wanting to figure out how to not pay for this, but other employers wanting to figure out how to pay for it because they thought it would have positive knock-on effects for their employees. That intrigued. Now, what's happened since then, several months have gone by since I checked in on that. And some of the things that happened since then is Novo Nordisk has become one of the largest, most valuable companies in the world. That's
Same
one.
with Lilly.
And then the next is that silently, many certain demographics have started to get and use Wegovy or Ozempic and Wegovy. And one of those, unsurprisingly, is rich people. So, but there have been some surveys showing that wealthy people have been losing weight. So soon this is going to be a phenomenon of you go into a wealthy neighborhood or an event that attracts wealthy people, and everyone will be thin at that event. And so that's and the second is that there's a very sizable industry of helping people manage their diabetes. All sorts of there's general, I have type 2 diabetes with no symptoms, or there's more complicated. I've gotten to the point of having major complications, etc., and dealing with obesity related to diabetes. And these sectors, they knew something big had happened 6 months or a year ago, but now they're starting to deal. They're having to figure out their future, and their future may be being involved in prescribing Wegovy. That's one possible avenue, or radically changing where the value is going to the drug, not to what these skilled people who sell and help you sell services, helping you manage your diabetes, not what they have to offer. So I'm seeing just the continued ripples of Wegovy. And I'm hoping there's no second shoe to drop. The second shoe would be bad side effects, if there are. And we've been using this drug long enough under the care of physicians that we haven't really seen a lot of bad side effects of it, especially considering the alternative to not taking the drug and living with diabetes and obesity, etc. But I hope there's no second shoe to drop. But I think this continues to be just a massive story. So,
Yeah, no, I agree. I can give you the for and against in this, to stay neutral in the matter, which is, these are expensive drugs. So, the first thing that always comes to mind is the drug priced appropriately. And, this is the mystery of the US healthcare system when it comes to pharmaceutical products, which is list price is high, net cost is some sort of mystery depending upon who you are in the supply chain and what you're buying. And, when you have limited supply, as you do right now for some of these products, you have alternatives that are coming out of, compounding and other facilities that, are 1/4 the price. So how can something that doesn't have the scale as the innovator offer the same exact product because it's using the patent formulation? It may have a different delivery, to be fair, a syringe versus an EpiPen, but the actual product's being delivered for a quarter or a third of the cost, net cost even. That's the first question. It seems like, hey, there might be some good news, but did pharma do what pharma always does to the US market, which overcharges the US citizens? People have defended this forever. Like, well, we need America to pay more because you fund the R&D, And I'm like, I think the federal government plays a role in a lot of the, research grants that are done in universities and other things. But, I think that argument is starting to wear a little bit thin on some people. I think, but let's focus on the positive side is, I do have some customers that are showing positive results. Now, I want to say, what is a positive result? You're paying more in pharmacy. So your pharmacy is off to the races 20%. Question is, can you make up for it in your medical claims data? And what I always want to point out is longitudinal data is always going to tell a better story for a drug that has, good efficacy, good outcomes. But you need a stable population. And what I mean by that is if you have like a union, the average tenure of a union member might be 12 years, but the average tenure of an employee in corporate America might be 3. So just when I'm starting to get good results, I get a new batch of people that some might be healthy, some might be unhealthy. And so it's harder to get an ROI when your patient population is cycling very quickly versus a stable population. You have very stable populations in unions as well as public sector, people that are getting pensions. Like my mother was a public school teacher, so she wanted to make sure she put in her 25 years as a minimum. I have friends that are police officers and again, put in their pension time. But I think this is important, which is those populations will benefit more. And so, there's a little bit of a moving target depending upon what type of plan sponsor you are, corporate America or a more stable long-term value you're going to see in a union or public sector fund.
Great, thank you. And so now moving on to trade journal stories. I was really glad to see that Waystar IPO'd. So they IPO'd on June 6th with an offer price of $21.50. And they floated $1 billion worth of equity. And they have a current market cap of $3.6 billion. So this was known as a high quality company in revenue cycle management, mature, cash flow positive, trading now at, last I checked, 21.52, which is flat. And so I know that the reason for this IPO was not to take advantage of a chance to see a big pop in the market. The reason for the IPO was that there were private equity investors who'd been in it for a very long time, and they needed liquidity to get out in order to be able to move their careers forward. And so they floated it, and they weren't doing it in order to open the capital markets for everybody else. They were doing it for their own reasons. And so they got out. Usually what we care about is the IPO window open? And I guess I'm going to make a call that this did not open the IPO window. This is not what it looks like when the IPO window opens. Usually what that looks like is really high quality, highly expected companies go public in biotech and healthcare, but not digital health. And those companies, their stock price goes up 15% and stays up. And when that happens, then investors feel rewarded and more confident that the aftermarket can be managed, and they'll have visibly good outcomes. And so then there's demand for IPO product from big investors like BlackRock and Fidelity, but they want to know that the stock price will go up and stay up, basically. And so they didn't see that with Waystar, and therefore, and once this happens in biotech and healthcare and tech, like if SpaceX were to IPO or something, then those digital health unicorns that are waiting in the wings, that are perceived as more growthy but not as high quality earnings probably by the market, they're going to try to go out and get liquidity for their investors. But I don't see Waystar as opening the IPO window. It's a little disappointing that it's trading, that in an up market, it's trading flat for half a month. So it's nice to see an IPO in this market, but it doesn't have any significance for the many digital health unicorns that are waiting to go public. So, AJ, what do you think of my call? Do you have any further thoughts on this?
Well, yeah. I mean, I think Waystar, if I just look at the profile, I think it has good bones. It's got good fundamentals, I think where I want to be fair. I don't think this is a stock anyone gets excited over ever, where they say, oh my gosh, they're doing something so innovative, new, or incredible. And not to discount what they're doing, that I haven't heard that story yet. And so I think they have a large market, large customer base. I think, I could be wrong on the EBITDA growth. For whatever reason, I'm thinking 10% year over year. If it gets to 15%, is that even more attractive? I think what makes Waystar attractive, once it gets over, it seems like it has a little bit of a cold coming out of its IPO. It's a little under the weather. But I think once investors warm up to its fundamental, profile, the indicators I look at is a decent, stock at the end of the. I always want to say I'm not recommending this to anyone, but I always want to say is it. I think it warms up, not because they're going to tell you about, this isn't an Apple, or they're going to tell you about their latest product launch or integrating AI into their products, or, this isn't, Microsoft making a strategic acquisition or investment, or, things like that. I just think it's going to be a story where, hey, if I could grow EBITDA year over year to 15 to 17%, that's a really interesting story to me as an investor. And, I like that about it. So that's what I see is, you know, it wasn't a stock that caught people's imagination. I mean, if I polled 10 people on the street and asked what Waystar was, I don't think anyone would know what it. I'm in the financial district right now in New York City. I'm at One World Trade Center. If I went literally, the New York Stock Exchange is 6 blocks away. If I were to walk between here and the New York Stock Exchange, obviously the odds of me getting a correct answer there get better and better the closer I get. But if I were to go right downstairs to the memorial, no one would know what Waystar is. And I think that's part of it is, it's a company that, if I remember its history, started turn of the century, so it's 24-ish, 25-ish years old. It's a rebranding exercise. So it's not like my Coke can and everybody knows what it is forever. And it doesn't necessarily have like this kind of rocket ship story behind it. It goes back to, it's just good fundamental numbers. It's that's why I think it is exactly where it deserves to be right now.
It sounds like you're also saying this doesn't herald an opening of the IPO window in the near future. So we're still
Not,
looking.
yeah, I don't think with a result like this, but if 6 months from now, the stock's trading up 30%, I don't know. Depends on who follows into the pool right now.
Yeah. So next is really interesting, Function Health. I'd heard about this company for several months. I didn't realize they were cooking up a large Series A, but Function Health, which is a wellness company for consumers, just announced it raised a $53 million Series A led by Andreessen Horowitz. That is big enough news as it is. So what the company does, among other things, is it sells a product to consumers that includes 100 lab tests, and then you get your data back, and then you manage your health for optimal fitness, optimal wellness, longevity, other these are very topical matters. It's an expensive product. There's a Boston company in my neighborhood called Inside Tracker, does a very similar thing, has been around much longer than Function Health, is a great company, has a great product. So Function Health's very much gunning for this same area. And being backed by Andreessen Horowitz, that's enough to gain attention. It's also strongly backed by celebrity doctor Mark Hyman. So Mark Hyman, maybe a lot of people have heard of him. He's written a number of the most best-selling books in the field of wellness. So this is clearly going to carry his brand and his style of medicine forward. But then it's also backed by Matt Damon and Kevin Hart and Zac Efron and others. So you see this happen about twice a year when a company gets major celebrity backing in digital health. Often it would be consumer oriented, which this company is. So really interesting story there. I had heard they were also partnering with Equinox. So that's a great move. That's a very synchronous brand right there, Equinox. So you could imagine someone who wants to pay more for their gym, they go to Equinox, they get
Sure.
the best gym, and they're also paying to be around other people who are typically young, attractive, and fit, among other things. And then this is a product for those kinds of people as well. So great brand synergy there, I would say. And any thoughts on Function Health?
Saw the headline, and smart investors coupled with superstars. I always say that firm clearly must be from the West Coast, because we don't see that as often on the East Coast, and certainly not from the New York area. Matt Damon was not in my cap table. But I think it goes with it. Maybe it's a lifestyle thing, and they're like, hey, if we get some stars, that will now talk it up to other stars and push it through Instagram and other channels. It's some free marketing, and for them as shareholders, it's going to hopefully increase market capitalization and value over time. So, it makes sense for a stock like this. So yeah, I think the valuation is significant. The size of the round is certainly material. You have to, I don't know the details of the market. I haven't done any research on it to look at the TAM or, revenue expectation and growth, but clearly they needed capital, a sizable amount. And I think part of it is, I don't know the model, but it sounds B2C-ish to me. I don't think they're going through employer groups and saying you should roll this out, but I'm sure there's a B2B aspect of this one day. But yeah, we'll see what it has. I have some sort of hunch that there's GLP-1s in the background of any fundraiser.
That's great. And then Adonis Health announced in the last couple of weeks, they are an AI for revenue cycle management company. New York-based CEO Akash Magoon. They raised a $31 million Series B round from 0.72 private investments.
Sure.
And also in the round with Kin Ventures and General Catalyst. So this gets at a point that annoys me, which is that you see leading mainstream fundraisers that don't have leading mainstream digital health venture funds behind them. So 0.72 private investments, you don't hear them doing a lot of digital health investments, and they're not a digital health venture fund. They are part of a hedge fund. So it's a New York story. You can't swing a cat in Manhattan without hitting a hedgie. And so it makes sense that some would raise money, but why wasn't this round backed by any of the 30 mainstream digital health venture funds in New York and Boston? And for the last 2 years, the answer has been that those funds have been overly conservative. They've been sitting on their hands on the bleachers and not swimming in the pool with the CEOs. And so this shows, I think what this shows is a CEO getting it done and raising the round, even though there was reluctance among mainstream funds. And so he turned to hedge funds and had success with hedge funds. So that, I guess, with these two rounds, there's been quite a few fundraisers in the last couple of weeks. And so does this, to you, and here we found one led by Andreessen Horowitz, where a leading mainstream venture fund backed it, and another led by a hedge fund, maybe because the leading mainstream funds were being overly cautious. But I'm seeing what I would call a pickup somewhat in the number of deals at seed A and B in the last 3 months. So I think the market was flat and terrible in the first quarter. I think there's been an uptick in the second quarter. And what I'm calling as a view, a future prediction, is that in terms of number of deals at seed A and B, it's going to be up 25% by the end of the year as compared to the first quarter and prior quarters, which were flat.
Yep.
So to me, that's a substantial uptick. And I'm wondering, does the news you've seen support that, or would you say you're not seeing the market improve a little bit? I think since April, we've been seeing the market improve a little bit. Do you have any thoughts?
I don't track, at least not a reliable index that I know of, regarding venture deals. This is more anecdotal of people that I know that are raising. And so I would agree with your assessment that Q1 was miserable for a lot of people that were fundraising, but they found a buyer in Q2. They found investors. And so, I think the market from my lens is picking up a little bit, for earlier stage investments where I think some people were reticent to deploy capital because of the risk involved or perceived risk involved, perhaps. So I think the criteria went up considerably for what was a good Series A or seed investment versus prior years. And that created a difficult environment, but I am agreeing with you. Some folks that I know that recently closed investments, congratulations to them. Q2 seemed to get the job done. So we'll see if it continues through the rest of the year.
Yeah, well, I'm glad to hear you also think you're seeing a sort of a little lift in Q2 as compared to Q1. So next, two mergers. So we're not used to seeing mergers. Mergers have been so in the context of since 2009 through the present, mergers and consolidation have always been weak in digital health. From the perspective of the last 2 years, mergers were very frozen, except for distress sales. There actually was an uptick in asset sales, which usually means a very distressed situation, bad news, sad all around. But here we're seeing that Knownwell, a hybrid, that means virtual and bricks and mortar, a hybrid weight inclusive primary and metabolic care provider backed by Flair, with a 20 million Series A recently, announced this past week that it had acquired an AI enabled precision metabolic health management company, Alfie Health, which had previously raised 2 million in funding.
There's my GLP-1 lurking in the background.
It could be that companies had to pivot because of GLP-1 and had to either raise a lot of money or sell or exit the line of business they were currently in or something. Yeah, so really interesting. By the way, that would be a fascinating Twitter account. Would be someone finding the GLP-1 basis for everything that's happening in healthcare or something.
Well, Steve, this is pretty funny, which is my co-founder and I for April Fools created a fictitious company called Glipsy. And it was basically an AI health enabled obesity management tool that focuses on the benefits of GLP-1s. And so, and I'm just saying is how could you not, kind of graft onto this and just be like, there's a moment where, you have a company like Lilly that's $800 billion in valuation. If I told you 3 years ago that Eli Lilly would be a higher market capitalization than, say, Tesla, you would think I was crazy.
Mhm.
But here we are. By a good $200 billion, they're more valuable. And so, I think everybody is kind of grabbing on to that Bronco. Be like, like this is it. It's going to take me to some finish line. And so, I mean, it was hard not to miss this, and so we were just, look, I want to make this very clear. There are obviously companies that are providing value in this area, but it's no coincidence that at the core of a lot of this is just sell more GLP-1s and get paid on it.
Well, so I brought this up because this was an acquisition in today's market, and the target company, Alfie, had only raised 2 million, so it was presumably relatively small. So this is a small deal. But acquisitions have been very weak in digital health, and here we see one. The second one is Progeny Health. So that's the old WebMD team and their CEO, Pete Anevsky, and I knew him when he was CFO at WebMD.
Sure.
They offer employer-focused fertility benefits, and they acquired April, which was a German fertility benefits company, and this was part of international expansion. And CEO Pete Anevsky said the acquisition would increase their global reach, allow them to sell in over 100 countries in over 225 languages. So good for them, very interesting. Most U.S. healthcare companies are obsessed with the U.S. space. Employer benefits companies are obsessed with the U.S. space. They're usually not. They're They usually view it as a step down to go overseas. I think that's short-sighted. They should go overseas. But there's two prominent acquisitions, so does this indicate a trend toward consolidation? Well, I've been saying that I think we will see a trend toward consolidation, which has to do with interest rates going up, small companies having disadvantaged access to capital, large companies still having advantaged access to capital, and the prices of small companies coming back down because interest rates go from a risk-free rate of 0 to a risk-free rate of 5, and those small high-growth companies, their valuation comes down, makes them more attractive acquisition candidates. So, do you think that these news stories are signs of a trend toward greater M&A, greater consolidation this year?
Well, I mean, I think it's depends on the segment you're talking about. So certain entities need to be careful in any type of M&A because you might attract the attention of the FTC, right, wrong, or indifferent. And he probably doesn't have that problem. So I think they've been a successful organization, especially if you look at their stock performance. They've done an excellent job continuing to grow. I think expansion overseas is a natural place to go for a mature growth stage company, continuing their ramp. I don't know much about the acquisition. Was it in distress, not in distress? To your point, were they just willing to sell for a reasonable price or a more reasonable price than they would have in the past for a lot of the reasons that you mentioned? So, I will say this is there's certainly an interest or more of an interest in M&A, I think right now because of the stalled market. I think for the market dynamics that favor big over small or up and coming. And I think my guess is we're going to continue to see this until something changes.
Yeah, that's a good point. So, Biden's administration has blocked a number of mega mergers, and that has been the cause of great concern. We don't know what they're going to do next. It's not clear. And VCs feel that this is a key way to exit, is through acquisition. So this is throwing a sort of a wet towel on things. But while you have to be concerned if you're so most digital health companies are small software companies. You have to be concerned about that direction.
Yeah.
I also don't think it has thrown a damp towel on digital health because these deals are just too small. Buying a $100 million revenue company is big by digital health standards, small by Justice Department standards.
Agreed. That's what I was saying. I didn't think Progeny has to worry about it. But when you talk about consolidation as a whole, if you have entities that in the past have been active participants in M&A and exits and now are hesitant or reticent, you now rely upon kind of the mid-market to kind of lead the charge on some level.
Yeah. And did you have any stories you wanted to bring to our audience? Trade journal, business news type stories?
No, nothing of note this week.
So we're going to skip a couple sections in our show agenda and move on just for time reasons because we're at the top of the hour mark to the main topic. So the main topic is what adds sizzle to a fundraise or acquisition. Some managed to win attention, look like winners out of the gate, seem to easily kind of jump over the roadblocks in their way. And we're trying to figure out both what those look like and also how could a young company leader listening to this show position themselves better? What do they need to meet for a Series A, for a Series B? Could they do anything to be more attractive when they go into their next fundraise? So I guess I'll start with, can you describe the current state of the fundraising market? And has it changed recently? How does it compare to 6 months ago, but also to 3 years ago?
Yeah, I
So
mean, 3 years ago, I think the criteria has shifted quite a bit. Where seed companies are kind of being treated like Series A companies. I want, established product or service in market. I want clients. I want, references. I want to see growth. I want to speak to customers. I want to see an established team. You're getting judged earlier as being a more mature entity because people are rejecting risk. Like why do I want to pay for seed level risk? And it's not to say that all seed investors had left or, created this higher criteria, but it's certainly clear to me that the criteria has increased to prove to an investor you're an investment grade, you're worthy of us spending the time on diligence with you, let alone deploying the capital. And so I will say, I think over the last 3 years, the criteria has certainly been cranked, not to the favor or advantage of the entrepreneur. And I think in the last 6 months, has there been some easing? I don't know if the criteria has lessened, but I believe that people are willing to take a little bit more risk. So I still think the higher expectations are there earlier stage, which didn't exist 3 years ago. But I think to our earlier point, we're seeing more capital deployed starting in Q2 of this year.
that's great. And have you seen any during the FDA markets where you can get a very high valuation with zero revenue? Have you seen any kinds of standards? Like I just recently I saw a company contemplating a 10 million or a venture fund looking at a $10 million fundraise, and they said we would expect you to have at least $1 million revenue for this. So that's interesting. That's kind of a formalization of what are often loosey goosey things.
Yeah.
Is that in line with what you're seeing, or is it stricter? Are you seeing stricter, or is it becoming less strict? Or
I mean, it depends on the segment.
okay,
That number ratio could change, but I just think it's just contrast from before, which everyone should be aware of, which is, it's become more difficult. And I've spoken with plenty of aspiring entrepreneurs, and, tales of woe and sadness, tends to follow them. And these are, bright, articulate people with good ideas, and they're trying to make those ideas into, real functioning businesses. And in the past, access to capital was easier. And so you had more people, moving to the Series A or Series B, and, they're stuck. Do I take more friends and family money and try and get to what would be a reasonable milestone to attract, investors? And so, yeah, I think it's real, the friction point still.
so there have been some news articles chronicling what I'll call the hangover and headache of the last call it 4 years, which
Yeah.
was that investors were flush with cash. Investors put money to work. They were in a very competitive situation trying to get companies to take their money. Um, and then the markets froze and valuations came down. And that was very bad for those same investors because the companies they already invested in couldn't raise a next round, were not on a track to proving out, and were facing down rounds where if you don't get the participation of the prior investors in the down round, the future of the company looks less certain. If you don't get the prior participating investors to participate, then they could get wiped out.
Yep.
And so did we learn anything in the last 3 years? Is that going to happen the same way, play out the same way every time, or are there lessons that we could and should learn about? You hear some investors say we're being disciplined, and then during boom times they wind up not putting money to work, which is its own problem. So, are there any lessons? And then also some companies are discovering that taking a large round at a high valuation can set you up for a big fall in the future
Yeah.
as well. So are there any lessons to learn about going through what was it, a bubble? Maybe we can call it a bubble now, and being able to make
Yeah.
it through without being hurt on during the bubble and after the bubble.
Well, I think you make an excellent point, which is, what becomes like your hurdle rate if you have a really high valuation. How do you make that a positive fundraising event again? And so your expectation is through the roof. And so, my own personal experience, I always say better lucky than good. And there were times I found myself envious of people with, much larger valuations, and I was like, how did they get that valuation? My gosh, they're geniuses. They're so much better than me. I'm like, I failed my team. And then you get the pullback, someone who says, you have a $1 billion plus valuation and you've been in business for 3 years, 2 years or something. And where do you go from there? And 2021 hits, and into 2022, and you see these entities trying to go back out, and it's hard to justify even the prior valuation. And even, I always say is if you saw some things that were acquired during this period, would these companies command the same valuation they did? And the answer is no way. You know what I mean? So some people got off the ride and were lucky. They were able to time it, back to better lucky than good on some level. You thread the needle. I was very fortunate and I had a good board of directors, and they said, AJ, you just can't worry about that. Just focus on what's in front of you and the company. There's always going to be some crazy story, and we're never going to understand the valuation or what went into, that term sheet, and that's fine. But you have the capital you need at a reasonable valuation to hit your growth goals and technology and R&D vision. And let's just focus on that. And so we'll have a reasonable, goal for the organization. So when we do raise money again, we'll have lots of interested investors because we won't be overblown in valuation. And we threaded that needle. And so I think a lot of times it's easy to get caught up in that. The other thing that you see, not saying all companies, but quite a few, people receive big checks. And obviously, you're a growth oriented company. You must deploy the capital reasonably, but they deploy the company at such a high valuation, or high velocity, I should say. They're needing to replace the capital. Like, oh, we'll just raise again at 2x or 3x. And then it didn't happen. And then they have no cash reserves, And so I think there are some lessons that entrepreneurs should heed and have heeded, which is be a little more conservative. Maybe don't think about the highest number possible on the term sheet. What is your absolute requirement or need for capital? What are you going to do with it? How are you going to deploy it? The other thing is, from an entrepreneur standpoint, how much capital you're going to keep in reserve. And then I think for the investors, they're thinking similarly. I don't want to be writing down investments in my portfolio or correcting valuations. That doesn't look great. I think, if you look in the journal, there was an article, I want to say today or yesterday, on the 2021 vintage of, VC, capital deployment, where I think the average return rate in 2021 was 3% compared to 2020 was percent. And so it's a real bummer of a year, especially if someone has to go out and raise capital after a 3% return. And it wasn't a great showing relative to other market indices. And so, I think there's plenty of lessons for both entrepreneur and investor through this period.
I think that's well put, and I would add, and this is very similar to what you were saying, but sort of the lessons are things like quality, which is that you you have a vision as to what you could reasonably accomplish realistically over the next, say, 3 years, and then you raise just enough money to be able to go do that. And then you turn to the kinds of investors you'd want to have on your board, the kinds of investors who bring real expertise, who can bring real value, who've done it before, have experience. Other entrepreneurs feel well treated by those investors, and then it's very exciting in that moment to have a tourist investor show up and tell you that you're worth more, and they'll give you a bigger round at a higher pre-money valuation. But that's not quality. That's the opposite of quality. So sticking with um, the networks who will support you, and who have helped people through ups and downs in the past, are not going to run away when healthcare hits a bump in the road and scares
Yeah.
people. That sort of thing. That's one. But then, that's the wise advice. I think the lesson learned. But it's also the case that when you're in a bubble, it's very hard to know you're in a bubble. And when you're in a bubble, you have to work with people on the terms of the bubble. Almost nobody's going to work on terms that, prices change all the time, and you're saying, well, that's the price of it today. And so it's very hard to fight against things which are, bubbly, and which then turn out to be a mistake later. So it's easy to say, stick with quality, but then it's hard to keep your head when all of the metrics are saying that. And I'll give you one example of this. I knew an entrepreneur who was doing the good things I said, and he was very much a Boston guy, building a software company in Boston with Boston investors, and he was hitting a single and raising money, and hitting a single and raising money, small amounts of money, and everybody was aligned on capital efficiency. And then a company in California raised like a $300 million Series A to do exactly what he was doing. And he said, holy moly, I'm going to have my top salesmen stolen away from me. They're going to go after my biggest customers. I need to raise a giant round to match them. So he went back, but his network was locked in, and they wanted him to stay the course.
Yeah.
And sure enough, the company with the giant fundraise went and stole all his salespeople, and then stole his customers, and his company crashed, and he couldn't anyway. So and that might have been that was an earlier bubble, I think. And so it's easy to say, hard to do. So,
Yes.
uh, so wait. So let's see.
You want to get to the sizzle?
Yeah. Why don't we go to that question, which is that you've got young companies, and they're riding trends, and they have innovative products, but they'll find, first of all, that investors are often a little cold, a little hard to approach. If they successfully raised a seed, they know seed investors, but now they're supposed to raise an A from different investors. They don't know those investors, and then those investors, and they're doing the best they can, but they're not, they're not Noom or some incredible, once in a lifetime opportunity. They're not eBay or whatever. And so, how do they reach those investors, and how do they show some sizzle that gets many investors excited about them? And let's talk about the A and B stage here.
Yeah. I always say the first thing is look in the mirror. And it's funny, you used the word attractive earlier. And large fund once took a look at my company, and they said, hey, we love what you're doing, but we're going to pass. And I said, oh, okay, no problem. They said, we want to give you feedback. I said, okay, I love some feedback. And they go, look, we're a data-driven investor, so we want to share some metrics with you. And I was like, okay. And they're like, look, we love to find a founder that graduated, Stanford, Harvard, MIT, in engineering. And I said, okay, well, that's not me. And then they said, we also like to find people typically that are alumni of Google, Microsoft, Meta, that helps us as well. They're trained in a good framework of engineering and software development. It's not me either. And then the other thing is, we typically like to invest in people under 40 years old. And I'm like, at the time, I'm like, that's not me as well. And I'm like, well, I'm for 3. So this must have been a pretty easy decision for you. And so, I went home, and at first I didn't sleep very well, but then I fell into this, very peaceful slumber. And the realization was in the back of my head is I like data as well. I go, if they were 100% successful, or they outperformed everyone by a wide margin, which is not the case, and they've certainly had massive failures as well, that it really was nonsense, but back to the sizzle. So the first thing is you have to look in the mirror and understand who you are. Now, if you're what they call central casting, the perfect star, and you hit all three of those categories, your path is already going to be easier than someone for me. I just want to be fair about this and someone be like, well, that's cruel. That's life. I'm sorry. You know what I mean? So your job is to then determine what will set you apart from everyone else. And there are things that obviously that particular fund didn't draw upon, which is, real world experience. Are you a subject matter expert in your field? Like, why are you starting your business? Are you someone who was in, let's just say ad tech, and then, you went to fill a prescription and the prescription wasn't great. And so you decided to create a company to, solve that problem. All right. Are you a subject matter expert? No. Could have you have had that other criteria I just described on some level? Yes. And maybe that's why you got investing. Or is it that you are a subject matter expert? And for myself, I came from the route of I've dedicated my entire career to the pharmaceutical supply chain and software development. And my experience helps. I'm also a serial entrepreneur. This is my third company. And so you can kind of track my record, wins, losses, ties in there as well. And you say, okay, he experienced manager, knows how to scale teams, et cetera. And so what I say first for every person who's raising money is know who you are in the mirror and be brutally honest with yourself. Because if you can't sell against your weaknesses, the people judging you are going to go right after them. And be ready. Be ready with crisp answers. You know what I mean? Why should I invest in you? Let me tell you why. And have, get at it. But so the first thing I want to say is just set your expectation. You know what I mean? The next thing is you might adjust what type of fund you're going after, because there are funds that like people that look just like them. Let me be frank. And there are some funds that are like, I like people that I don't care what they come from. I like people that I just have believe they're going to be successful, or they're angry inside and they want to fight, and that's important to them. Who knows? One of my investors once said, hey, you have the biggest chip on your shoulder I've ever seen, and that's why I want to invest in you, because you're not going to quit. And so, so what's sizzle? Sizzle are the characteristics that make you unique. And I want to talk about the management first. It's not just you. Often there might be a team. And so that helps quite a bit. But I think the other part of it is, what are people looking for? And I want to take you in a time machine. The year is 2007. One of the largest funds in the world is talking to me at the time. And they said, Jay, this is at the time, it's 2007. They're like, look, this is my criteria, is minimum 15 million ARR, and you have to be in some sort of cloud-based SaaS platform. That's what I'm interested in right now. And I was like, gosh, like I didn't make that criteria, but it was a lesson, not so much about what they were looking for, but to think about where you are in time and what's important to an investor. There was a time where, anything that was blockchain or crypto seemed really exciting. And now we're entering an age where AI is driving a lot of stuff, or people grafting onto GLP-1s. But there's a moment in time where someone is interested in something in particular, and to do your research and to find what different funds are thinking about. So sizzle could be whatever the topic of the day. Now, someone would be like, great companies are what I'm looking for. Yes and no. I honestly believe people are a reflection of the time and their interests. I mean, I think, Steve, you would agree, there's quite a bit of interest in AI anything right now. Well, that's an interesting trend. And so even if you aren't an AI company, how many investment docs do I read where AI is in the opening paragraph, even though it's not a true AI company? It's not like someone's building out some massive neural network and they're going to, challenge, Chat GPT for the throne here. I mean, there are people that just say like, we leverage AI for blah, 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 and it's in literally their thesis or opening statement. So I think, what I want to summarize this is know yourself, know who you're selling, because your product is you as the entrepreneur. and be honest with yourself and find funds that are going to match your personality, your criteria. The second thing is be aware of where we are in history, and certain things may age you. There's nothing, wrong with using AI to help sell you. Just be aware. It could be a benefit, but also be aware that most investors are fairly sophisticated and they're going to challenge you on how are you using AI? You better have a damn good answer because most people are pretty smart in this game. And so I think these are the two biggest factors that I want people to be aware of. Nothing is fair. The last part I did want to make one point about, because I did hear this from a couple people that are raising money right now, is they're like, it seems like my business model is too complex. People don't want to learn it. And I empathized with them because my original business model was about pharmacy benefit managers. Most people don't even understand pharmacy benefit managers. And the second thing that comes to mind is how could you beat Fortune 15 companies like CVS, Cigna, and United? You're crazy, go away. But the people that did the homework and stuck with it and saw something in myself or the business model or the plan and were willing to take a chance, but you need people that want to do the homework. So unless someone has a very simplistic business model, that anyone can understand, in 2 sentences, that's great. That's amazing. You have a very clear business model. It probably has a great TAM and you've already worked out a way to make money on it. Amazing. But for a lot of us, especially in healthcare, you're dealing with very complex ecosystem, markets, competitor, barriers to entry, compliance, regulation, and you need someone many times who's willing to do the homework. So my last point in this is remember, you're dating your investor as much as they're dating you. Try and figure out if people want to do homework. I can't stress this enough. Everyone on my board and everyone on my cap table were people that did homework. They were intellectually curious. They weren't like, this is complex. I don't like this. I want the simple thing. Next. They were like, walk me through this. Give me the unit economics. Help me understand how you're bringing down variable cost. Help me understand, the 3-year plan here on how this is, those are the people you want if you have a complex model. I just want everyone to understand that. So the more complex your business ideas, make sure you have people that want to do homework. Because if they don't, I have absolutely met people and they're like, oh, you're like a PBM. And I'm like, if that's the sum total of what you know about my firm, probably not a good fit. And I just think that's a lesson for any investor. So those are my 3 takeaways at any point in time. But that's, going to be a little bit of your sizzle is understand who you are and selling to, because some people, I will never be sizzle. They'll look at me and be like, you're an outsider. I will never invest in you. Other people look at me and they're like, I love this person. Oh, he's like a grinder. This guy will die before he fails. And that's understanding what makes you special and what will be interested in you. Again, I always say there are some key words you might want to weave in to this time and place in history. That's up to you, but be prepared to answer those questions. And the last part again is, you want investors that are going to invest in your model with you. Like they just can't be like, good for you. So those are my 3 takeaways.
Well, so by the way, reacting to that, I think that's a great way to look at sizzle with investors. And what you said reminds me of probably 3 years before the pandemic. So we're talking 7 years ago. I went to HIMSS, and the buzzword of HIMSS 7 years ago was AI. So this is before the open AI, large language model, generative AI wave. And so every booth had to say AI on it. Athena Health said AI on it. Epic said AI on it. Everybody said AI. And I also got to be in a meeting where company was a clinical decision support tool, and that the meat of their product was helping a physician make a decision about a patient. And then they also had a zero revenue product that was the patient's ability to access that record. And this had an AI chatbot. And sure enough, they went into an investor meeting and they said, we're AI. But that was not their revenue product, not their core product. They didn't need to have a patient portal to their system. Their competitors didn't. And they sort of got nailed for bragging about being AI when that was not an important
happens
model. Now, and we'll need to wind up soon for time reasons, but so one thing I've heard, and I thought you would touch on, is that to have sizzle, you need good fundamentals. And an example of this might be that to have sizzle today. So if you cycle back 3 years ago, there might have been a mantra of growth at any price. And so that might mean that you might sell sort of bad contracts at bad margins just to get more revenue. But today, you need good fundamentals. So you'd only want the best customers with contracts that are going to lead to high margins in the future at maturity. And so instead of growth at any price, it's more like good fundamentals make you have sizzle today. Would you agree that both that's the way it used to be 3 years ago, and that's the way it is now? Or what does it mean to have good fundamentals, and will good fundamentals, get help with sizzle? And what do companies do today to spot bad fundamentals and change them?
Yeah, I mean, I think that goes without saying. So this goes back to our earlier conversation of the criteria has shifted a bit from grow to grow with a reasonable capital deployment, demonstrate market gain with reasonable margins or contribution margin, however you want to look at it. And so, I think that is absolutely part of, that's table stakes at this point. I was focusing more on the sizzle of how you think about going out and, raising money right now or in any period. My prior points still stand, but I absolutely agree. It's table stakes right now for an organization to be a little more responsible and to demonstrate meaningful growth. And I think meaningful, again, is a blend of deploying capital at a reasonable velocity, burning but not excessive burn, having good cash reserves regardless of where you are in your cycle before your next raise. Then, making sure you have reserves. So if the negotiation you don't really appreciate where the discussion is going, you could wait. I have options. So I do believe the criteria has changed for the foreseeable future, but like anything, history repeats itself. So we'll see what happens.
And I saw this play out in the telehealth market, which is I saw a company go out and say, we're only going to sell to the biggest of the big buyers who tend to be high quality buyers, and we're only going to sell a Cadillac product to them. Because that Cadillac product includes programs for engagement to get employees engaged in using the product. And that allows us to 1 year, 2 year, 3 years later, show that we contributed value because the employees really used the product. Then they had competitors who would sell to anyone and would be happy to sell a Ford instead of a Cadillac. And that didn't come with engagement programs. And so that meant that a year, 2, 3 later, they couldn't show that people used the product. And that was during boom times. And it allowed the competitors to claim growth. We have more purchases today. We're as big as the leader in the market. And then you had a downturn, and all of a sudden, those competitors, they paid a huge price for having sold to buyers who weren't good buyers, who didn't care, who wanted to buy the cheapest product, and they were sort of swept aside. But the company that had held out for selling to the best customers and selling only a higher margin Cadillac product and proving the value and persuading through the salespeople the buyer to go for and appreciate that they had a higher quality product. That wound up, that's hard to do. It's hard to do during boom times, etc. But that's worth it, because then when you go to investors, you have this better story to tell. So
Yep.
Anyway, um,
No, I agree.
great. Well, any last thoughts on how to generate sizzle for a fundraise for our audience?
I mean, I think it's being honest with yourself. I think the harder you are on your idea, who you are, who you're selling to, the progress you've made, I think you're going to have an easier time. I think if you set the bar really high for yourself, you're going to meet the expectation of your investors. Probably not exceed it still, but I want people to go into this process thinking it is very difficult. I want to be fair. There are some people, they were ordained to just raise money at any valuation and do what they want. And that could have been predicated on, let's be fair, there's an entire group of people that are Gen 2 success stories from a positive exit that can just raise money anytime they want. But I'm saying most of the people that are starting for the first time, fresh out of college, fresh out of their first job, and they say I have an idea, or even, later stage like myself, and they were like, hey, I want to really go after this later in life. But I think you need to be brutally honest with yourself. And that will be the sizzle, that you've created such a high criteria and you've taken, all the things that we've acknowledged. These aren't secrets. And you've put it together in a very tight presentation that is really hitting on the points that are going to make investors, interesting. And, there's no secret to this. There must be 10 different templates out there of what a fundraising deck looks like. And each one of those, templates probably has between 8 and 12 slides you're going to want to present. And each one of those slides is important. And you have to be demonstrating a really powerful story. And so it begins with being hard on yourself and having you deliver a better product, a better work output, better sales results. And I do want to be fair, sales definitely smooth out any business presentation. That if you're hitting strong numbers, there might be some questions around some other things, but sales look really good here. And I mean, meaningful sales again, good contribution margin, good to the cost of that sale or cost of acquisition, however you may look at it, but also what I would say the overall burn or expense of the company in the early stages to get where they are. So, I mean, I think all of this comes together, and I think it begins with you being absolutely brutal with yourself. And if this doesn't sound attractive or fun, you probably shouldn't be in a venture backed business. You could be, what I would say a lifestyle business, but probably VC backed or investor backed isn't for you if you can't accept that level of scrutiny, including, introspectively coming from yourself.
Well, thank you. It's been great to have you on the show, and thanks for coming on board.
No, Steve, thank you. It was a lot of fun. Covered a lot of ground today, and look forward to perhaps a future meeting. We'll invite you on to one of our Capital RX Astonishing Healthcare podcasts, so you can join us.
That sounds great. Thank you. Well, so you've been listening to Digital Health Investor Talk with host Stephen Wardell, and special thanks to our guest, AJ Loicono. We're publishing this show as an episode of the Digital Health Investor Talk show. You can subscribe in Apple and Spotify, and don't forget to rate us. Our next show will be coming up on July 17th with venture investors Todd Pietri and Jared Bressner of Activate Venture Partners talking about a new birth of consumerism in healthcare. And then for the Boston members of our audience, I hope to see you at our upcoming, it's going to be really great, Boston Drinks Night, Thursday, July 11th at the Intercontinental Hotel Boston. And the theme is longevity. And we have longevity investor Fannie Miller of Quadroscope Ventures, and we'll have a number of other longevity and aging luminaries from the Massachusetts healthcare system there to talk about longevity and aging that night. And so with that, we'll see you next time. And thanks again, AJ.
Thank you. And I want the invite to the next time you go out for drinks.
Awesome. I'll send you that.
Thank you.
Yep.